You may be someone who has a credit score of 800 or above, and that's definitely great. Or you may be someone who has a less than favorable score of 500 or below. But do you really know the factors that play into your credit score? In today's video, we're diving into the factors that impact your credit score. Hi guys, it's Shama from Happy Living Now, where we share everything money, lifestyle, and living a happy and rich life. So in today's video, we're talking about the factors that impact your credit score. Many of us definitely use credit cards or some form of credit, but we do not understand just how much the credit decisions that we make either negatively or positively impact our credit score. So we're talking about the key factors that play into your credit score that will help you get to that credit score that you desire. So let's dive right in. Statistics show that the average score for the United States, an average credit score in the United States, is a credit score of 695. And about 14% of the United States population do not have a credit score or any credit at all. Now, I recently did a video on whether you could live without credit. So if you've not seen that video, be sure to check it out right here. So to understand your credit score, you need to understand that your credit score is made up of 5 key components. So the first factor in your credit score is the type of credit, and that's also referred as credit mix, and that accounts for 10% of your credit score. Now, what does credit mix mean? It means the type of credit that you have, whether you have revolving credit or installment credit or both. Now, you may be wondering, what the heck is revolving credit or installment credit? A revolving credit are things like your credit cards. You use them, you maintain balances on them, and you pay off those balances. That's revolving credit. That means that the balance varies from month to month or whenever you use it. Installment credit, on the other hand, are things like mortgage payment and car payment. Those payments are pretty much fixed. They do not change from month to month. They're fixed and they are to be paid off at a certain time. Okay. Now, lenders use your credit mix as an indicator of your risk level. They look at whether you have a good mix of credit to determine whether or not you know how to handle different types of credit. So if you have a good mixture of revolving credit and installment credit, they're going to use that as an indicator that you are someone who's able to handle all sorts of credit. Okay, so be sure when you're checking your credit to see whether you have revolving credit only, installment credit only, or a good mixture of both. The second factor that impacts your credit score is credit inquiry. And that also accounts for 10% of your credit score. That means how many credit inquiries or how many new credit applications you've made within a certain time period. Now, of course, applying for too many credits within a short period of time can definitely impact your credit score. Too many new accounts can also negatively impact your credit score because it impacts your credit history. So the more new accounts you have opened, that means those accounts have not been open for a long period of time. And so that's going to impact your credit score. And that plays into the third factor that impacts your credit score, and that is credit history. Credit history accounts for 15% of your credit score, and that means how long have you actually had your credit accounts open for. Of course, the longer you have your accounts open for, the better, because the more information lenders can actually acquire from them running their credit checks on you. So the longer you have a credit account open for, the more information that gives to a prospective lender. Now, can you have a decent credit score without having a long credit history? Absolutely. It does not mean that if you have a short credit history that you're going to have a very low credit score. As long as you're making payments on time and your credit utilization ratio is pretty low, you can definitely have a decent credit score even without having a long credit history. And so that plays into the fourth factor of your credit score, which is your credit utilization. Credit utilization plays for 30% of your credit score, and that means your available credit versus your credit limit. So that means how much credit do you have available when compared to what your credit limit is and your outstanding balance on your credit cards. Okay, Now, of course, you want to make sure that you're carrying small balances on your credit cards. If you are someone who carries balances from month to month on your credit card, you want to make sure that you're carrying small balances. Most people say that they give a good guidance and say that if you're utilizing your credit cards about 30% or below, that normally puts you at a good place for having a good credit score. Now, does that guarantee that if you're utilizing your credit cards at 30% or less, that you're gonna definitely have a good credit score? Absolutely not. There's no guarantee there, because those are actually measured individually by the card and across multiple cards. But it is a good place to start. I mean, if you are using your credit utilization at 30% or less, it may be a good place to be and a good indicator that you may actually have a good credit score. So credit utilization, try to do it. Again, not guaranteed, but at 30% or less of credit utilization could help you increase your credit score. The fifth factor that plays into your credit score is payment history, and that accounts for 35% of your credit score. Payment history means how long have you been making how long have you had your credit cards? How long have you been making payments? Do you make payments on time? Are you someone who misses payments? Of course, you don't want to miss payments. Missing payments definitely impacts your credit score negatively. You want to make sure that you're consistent with payments, you're making payments on time, and you're doing that on all of your accounts. That's definitely going to help you maintain a good credit score and have a positive impact on your credit score. Now, some people might be under the impression that if you miss payments on certain types of credit, that may have a greater negative impact on your credit score than others. So say, for example, you have a mortgage payment and you have credit cards. Some people might think that missing a mortgage payment is going to have a greater negative impact on your credit score than, say, missing a credit card payment. That's not necessarily true, okay? Obviously, there are two different types of credit here. Remember, factor one, the type of credit, 10% of your credit score. The mortgage payment is an installment payment or installment type of credit, and your credit card is a revolving type of credit. The key take-home point here is you definitely don't want to miss a payment at all. Whether it's a mortgage payment or a credit card payment, they can both negatively impact your credit score. One is not necessarily going to impact your credit score negatively more than the other. As long as you miss a payment, they're both going to negatively impact your credit score. The key to remember here is to definitely make sure that you're making consistent payments on whichever type of credit you have, and you're making those on time. You're not missing any payments. So those are the 5 factors that play into your credit score. You have the type of credit that accounts for 10% of your credit score. You have your credit inquiry that also accounts for 10% of your credit score. You have your credit history that accounts for 15% of your credit score, and that's again how long have you had your accounts open. You have credit utilization that accounts for 30% of your credit score. That is available credit versus credit limit. And then you have your payment history that accounts for 35% of your credit score. So of course, again, all of these 5 factors play an important role in your credit score. But out of the 5, you see that 2 of them are more than 50% of your credit score, and that's credit utilization and your payment history. These 2 make up 65% of your credit score. So definitely pay attention to all the factors that we talked about, but definitely pay very close attention to your credit utilization ratio and your payment history. If you want to obtain that credit score that you've always wanted, it's very important to pay close attention to making payments on time, okay, not missing any payments, making payments on time. And if you are in fact carrying balances from month to month on your credit card, definitely make sure that those are low. So if you are in fact paying attention to those 2, you're definitely at a good start. Okay, doesn't mean that you're there yet, but paying attention to credit utilization ratio and your payment history definitely is a good start to getting you to that desired credit score. Thank you guys so much for watching. I hope you guys enjoyed the content of this video. Be sure to be on the lookout for our next video where we actually share some tips on how to increase your credit score. If you haven't given this video a thumbs up already, please give it a thumbs up, share it so that we share the knowledge. Sharing is caring. And if you haven't already, definitely subscribe and hit that notification bell as well so you're notified on my next upload. See you next time. Until then, live happy, live rich, be blessed. Bye guys.